Hi, the purpose of this video is to help organizations understand integrated planning and performance management. And what we're going to show is a maturity model, and it's specific to manufacturing organizations. So one of the things that's unique about this maturity model is it's more process focused than functional focused. So if you look at a lot of maturity models out there, they're specific to things um, like project and portfolio management or sales and operations planning or finance. This one's more holistic, and it integrates strategy, finance, and operations. And it looks at planning and performance management on a more holistic basis. And just to make sure that we're rooted in reality, it's based on currently available technology in terms of what kind of processes can be supported. And while we can make reference to other industries, it's very specific to some of the issues that are faced in the manufacturing sector, especially companies that are more global in nature. So in terms of how we're going to approach this maturity model, we're going to go through 6 different sections. First, provide a little bit of introduction and background to it, and then we'll talk about the maturity framework that we're using. We'll then walk through the different levels of maturity. And one of the things that we'll be talking about are specific things that differentiate one maturity level from the other, and what some of the key outputs might look like. We'll then, after we look at the maturity model, we'll discuss a few specific topics to kind of bring some things home and then summarize. So in terms of the context for this maturity model, one of the things I find is that there's lots of terms being used in the marketplace that are just terribly confusing. So integrated business planning, integrated financial planning, integrated performance management. There's a whole bunch of other things which I think are that organizations and individual people find confusing. So one of the things that we want to be able to do in terms of the questions that we'll answer, like what's common to these concepts, why is integration important, what does fully integrated mean, and what's it look like? And then I'll answer the question, things like what's the difference between a rolling forecast and sales and operations planning, or what's the difference between integrated business planning and integrated financial planning, those sorts of things. So really help clarify some of these disparate types of terms that are being used. The audience for this video, first and foremost, I think financial planning analysis and treasury people are going to find it very interesting and helpful in terms of helping them understand why they're experiencing some of the challenges they're experiencing. Sales and operations planning people, especially those who aspire to have more integrated processes. Operational excellence folks who are seeking to drive cost reduction and performance improvement and strategy as well. In terms of the roles, people who are selecting software or trying to do some sort of process or assessment or drive performance improvement is really going to find it helpful in terms of thinking about where they are in the maturity process. Some of the features which I think are important to note about this maturity model, it really reflects convergence in both some of the technologies out there. So for example, between financial technologies and operational technologies, and some of the management challenges that organizations are experiencing, that some are reaching the point where their financial and operational challenges are highly interconnected. I think the second point is that one of the key challenges facing global organizations and CEOs is this issue of complexity management. I think that if you're going to manage complexity, integration is absolutely essential for managing complexity. And just from a competitive differentiation perspective, I'll use the term management systems. So the broader integration really drives, we believe, is going to drive a lot of competitive differentiation within companies, and really help them realize unrealized value sources that they've been trying to accomplish. So just a little background about this maturity model. And so if you want to get a little bit of background about some of the points of view, there is a webinar. It's on YouTube. It's called Finance as a Driver of Operational Excellence. There's some background information there that might be relevant as you're going through this, but a couple slides from that I'll just focus on. What we want to do is talk about um, how organizations can more effectively manage complexity and what specific capabilities they need to manage complexity. So as organizations reach a point of the complexity starts to erode profits. And complexity can actually be a point of competitive differentiation, but you've got to be able to manage it. So that's one of the things that we want to focus on. And ultimately, when you think about, especially financial planning and analysis, one of the things that you want to do with a management system is avoid what's shown on the screen here, is these unintended consequences. So these unintended consequences tend to be found in situations we have large global companies where there's a bunch of disconnected operations and management systems that you don't see the full impact of decisions. And to me, that's really people talk about a picture representing 1,000 words. This is kind of one of them. And when you don't have that kind of picture, these are some research studies that really talk about, what we're talking, the value of these management systems, if you will. I'm not going to go into each of them, but there's two that I would highlight. One at the top in terms of cost reductions, that 90% of companies don't sustain results for more than 3 years, and complexity costs 3 to 5% of sales. I mean, basically, what's common to all these different shortfalls is really one thing, and that's really the inability to connect resources to targets or inputs and outputs. And underlying all that are really two critical capability gaps: the ability to quantify resources, and that means the ability to quickly and accurately quantify financial and operational resources that support desired revenue, profit, cost, service, and quality targets. And the second key capability gap is the ability to quickly reallocate resources across functions and entities to optimize operating performance, project portfolio, ROI, and employee rewards. So those are, if you look at complexity, those are some of the two things I think that organizations are really struggling with. And they're struggling with those things across a bunch of management processes. So, if you're looking at this video, you may have done some of these things already. And a lot of organizations have tried a lot of these things, but I think that one of the things that they're finding is that they're now kind of hitting a wall, and that trying to make improvements to what they have, it's getting more difficult, and that difficulty increases with the size and complexity of the organization, and that's one of the things that we want to help them understand. So with that as a background, let's talk about the maturity framework. So we just talked about the two things that organizations were struggling with, and those are the dimensions of the maturity model that we're using. And when we look at these two things, I think that if you look at those unrealized value sources that we talked about, these two things, and then the third thing, which is a byproduct of the other, which is process speed, those things comprise probably 90% of the value gap that organizations are experiencing. So this is why we use this kind of maturity model. And with a maturity model, what we're going to do is we're going to describe 5 different stages of maturity. And what we're describing here are degrees of integration. And, so one of the things that we talk about in that degrees of integration is going to be, for example, driver-based planning. We're going to describe 5 different types of driver-based planning models and the alignment dimensions. So what does alignment look like at these different stages? And that really is just convenient for how we describe it. Organizations don't necessarily have to follow that maturity path. Certain levels of maturity aren't relevant to some organizations. So, the 2 boxes just shown on the screen there just represent the fact that your desired level of maturity may be different than what I've described here, but this is just for description purposes. So I've taken this maturity model and kind of broken it down into kind of 2 chunks. The one on the bottom left is what I call fragmented and functionally based, and the top right is strategic, financial, and operational integration. And if you look at most of the tools that are available today, so if you look at strategic corporate performance management, sales and operations planning, and integrated business planning, project portfolio management, what they're offering is what I would call kind of the lower end of integration, and they have certain things that they do or do not do, which really prevent them from playing a more strategic role. Um, for example, like they're really focused on individual stakeholder needs. So, even though sales and operations planning tools call themselves integrated business planning, uh, you know, virtually none of these tools support budgeting or the reengineering of the budgeting process. Or if you look at a financial tool, none of them effectively support sales and operations planning. So the main thing here is that finance and ops just have separate models and reporting systems. So they're and where organizations are at, they're trying to patch these things together to support some sort of integrated business planning process. And this can be confusing for some because a lot of the vendors virtually every one of the vendors call themselves fully integrated, and especially in the financial world, what they're really describing when they say fully integrated is they're talking about technical integration and they're integrating financial statements. They're really not talking about things that are really outside their own function. As opposed to what we're going to be talking about today in terms of more mature and integrated systems, which are more enterprise-wide, shared models and processes, focus on outcomes, cross-functional processes that break down silos. So some of the finance objectives that organizations are struggling with are kind of shown up here. And as you get more complex, one of the things that we're going to be talking about is, the specific capabilities that allow you to address some of these issues. Probably the two of which at top, like scenario planning and cross-functional alignment, are big issues in finance, but they're also big issues in operations. So, operations and sales and operations planning folks are trying to achieve those things, and some of the other objectives they're trying to achieve are really a symptom of poor integration with finance. So we're going to be talking about how to address that. And from a strategic perspective, a lot of organizations are trying to achieve things like flexibility and agility, profitable growth, sustainable cost reduction. They don't have the wherewithal to support these sorts of processes. So what we're going to be talking about is what the processes and capabilities look like to support these things. So what's really new here, and there really is no universal term to describe this. Some are calling it planning and performance management platforms. And these platforms are being supported by both financial and operational software companies. So this convergence is starting to take place that, some of these platforms from a financial sense are offering supporting operational processes. And likewise with some of the operational ones, they're starting to support financial processes. And not seeing this being covered by the analysts as part of a broader platform. I think if you look at how the analysts are looking at the market, it's still very functionally based. So what we're doing here is stepping back and looking at it from a broader perspective. So what these tools are offering are integrated planning models, integrated measures, integrated processes, integrated collaboration, integrated alerting and issues, and one business process framework, which we'll talk about in a bit. But the main thing is that these things are all shared across multiple applications. And to kind of give you a sense for what sorts of things that these tools support, if you can imagine all of these sorts of applications sharing the capabilities that I just mentioned, the planning models and measures, all these things are all shared across all these different applications. And the platform capabilities, some things which are kind of unique to them, all of these are based on relational platforms versus multidimensional or cube-based applications. They supported limited dimensions, embedded counter logic, multiple hierarchies, time-based everything, cross-entity processes. Those are some of the platform-based capabilities. Like I said, there is no universally defined term to describe this, but what I just want to draw an analogy here. I think that what's really happening here is what happened to ERP, 25 years ago. Back then when it first came around, there was no universally defined term to describe it until somebody came up with ERP and it stuck. So this is really what we're talking about, that the technology has actually now arrived to support this sort of thing, and I think it's a fairly significant change. And in terms of what we're going to be talking about today, we're not going to address all of these things, but the things in the red are the things that we'll be touching upon. So a lot of things. So one of the things we won't be talking about are things like internal control management, although these tools would support this. Human performance management, we're not going to get too deep into that, but just to kind of give you a sense that these platforms are really really forward-looking and doing some things which I think that a lot of people aren't aware of in the marketplace. So with that said, let's then talk about the maturity model and the specific stages. So first place we're going to start is stage one, and this is what we'll call the ad hoc. And as we go through, I'm going to be simplifying these terms. So I'm going to call the y-axis performance management and the x-axis planning. So at stage one, it shouldn't be a big surprise to anyone, but if you look at from a financial perspective, from a planning perspective, this is basic bottom-up planning and budgeting, periodic and minimal operational reconciliation. The drivers are pretty simple. Could be cost of sales as a percentage of sales and overhead rates, that kind of thing. Very simplistic financial measures. From an operational sense, they're operations folks are typically doing supply and demand balancing, workload and capacity planning, with little or no finance in the process. And like finance, the managers are using their own operational metrics. And more often than not, you'll find that companies are supporting these processes with spreadsheets, but that's not necessarily the case. You could have a process supported by an application that is fairly simplistic. So that was pretty basic stuff. So stage two is what I call functional standardization. And the characteristics of functional standardization, so from a financial perspective, many companies have kind of done a lot of this already. They've purchased some sort of corporate performance management system to automate their budgeting processes. Same thing with operations. They may have bought a sales and operations planning system. So from a financial perspective, they may be using some drivers, which I call operational estimation. So it might be cost of sales equals the number of units sold times the dollars per unit, or in a call center, it might be the number of calls times cost per call. And they may leverage some S&O input from sales and operations planning, but it's really not the final plan. So the main distinction here at this stage is that finance and operations are using separate models. So in the financial world, you'll have financial analysts who have to go out and talk to operational folks and develop their own models that represent finance. In the operations, they're also using other models to support their monthly S&OP process, and they may have some sort of financial estimation. So, for example, they want to do some estimation of cost differentials, so they'll have standard cost of sales, which include direct labor, overhead, and material. But it's not supporting scenario planning or analysis that looks at the company as a whole. It's only a part of the company. And in a lot of cases, there may be some sort of formal reconciliation process in the operational world between finance and ops, but it's a manual process. So fairly time-consuming. Again, this is probably not covering the entire organization. So from a performance measurement perspective, I think you'll find that the companies have implemented things like dashboards and formal financial metrics and standard costing and variance analysis. And in operations, they probably have some formal metrics as well that they have on dashboards. And oftentimes these are separate systems supporting these things. And then there's some other things that may be going on at the same time in terms of other tools and processes that they're using. So for a balanced scorecard, for example, they may have developed a strategy map. They've defined define their objectives and targets, and the targets are connected to the budgets. They may be using activity-based costing on a periodic basis to understand profitability, but it's certainly not embedded into some sort of planning and performance management process. From project and portfolio management perspective, they may have adopted a standard approach to product definition and execution, but this is a separate process. And companies at this point may be dabbling with business process management. So, I've implemented some sort of Lean Six Sigma program, and we're doing kind of formal improvement. We have metrics defined, those sorts of things. But again, usually separate from the other processes. So what happens at this stage, there are some pretty common challenges that organizations run up against, and this has to do with the fact that you're using fragmented systems. So, for example, in finance, forecast accuracy is an issue. Driver-based planning takes way too much time, or rolling forecasts. Trying to do any sort of sophisticated scenario planning that cuts across legal entities is usually still on spreadsheets. From an operational perspective, these are some of the classic things that organizations try to establish more integrated processes, and they really have some difficulty with it. And then some of the common things that people experience is that no end-to-end scenario planning, establishing a single view of the different versions of revenue demand planned globally. This could be a really big problem. So, you've got in your sales and operations planning process, you've got a demand planning system that's looking at what the demand planners view as demand, and then you've got in your financial world, you've got some revenue targets that you're trying to hit, and try to maintain those things together it can become difficult. Maintaining models becomes a big issue, and reconciling finance and ops functional silos is still an issue. And one thing which is actually pretty interesting is that a lot of companies get to the point where they see that there's little difference between a rolling forecast and sales and operations planning, but actually trying to execute those things inside a 4-week period within a month is proving to be difficult. So just the logistics of trying to get a single process executed in a month is challenging. And one thing that I often find at this stage too are these things called unwritten rules. I'm not going to go into a lot of detail about them, but one of the reasons why these things exist is because organizations can't connect what they're seeking to achieve with what they're willing to spend. So this input-output thing we talked about earlier, and when that happens is that people start exhibiting these behaviors when they don't think that target setting and resource allocation is fair, and they're really going to get what they need when they need it. So this is a classic symptom of stage 2 companies that haven't connected, target setting and resource allocation, and broken down, the functional silos that are driven by the budget process. So that brings us to stage 3. So up to this point, we've kind of talked about, where companies are at. So let's just talk about where we go from here from an integration perspective. And I've broken this up into kind of 2 stages, and which I'll distinguish in a sec. So at stage 3, I call it one plan. So from a planning perspective, this means that one model is shared between finance and operations. There's no separate system. It's one system that both are using for both a rolling forecast and sales and operations planning. From a performance management perspective, one of the things that's happening is what I call matrix management. I think where business processes people see business processes as being important to have one kind of view of the outcomes of a company. Having cost reduction inventory always available, which means that I always know, what my processes are looking like. I always know the non-value-added activities in my processes going forward. It's always available. I don't have to do a special cost reduction study or anything like that. It's always available. There's one business process framework that's been embedded into a planning and performance management process. And the planning assumptions that are part of the planning are exposed in the measurement system. And that's a really big issue because most companies who do planning, assumptions are often buried in spreadsheets. Just a couple things about the planning as well. One characteristic here is that when you get to this stage, sales and operations planning and activity-based planning become one process because it's very much the same sort of math, and we'll explain that in a sec. The thing that it differentiates this stage 3A from 3B is, the degree to which you have embedded modeling logic here. And because this really impacts your ability to do scenario planning and what-if analysis. So if you look at different applications, some will tell you they can develop kind of custom code and, support a planning process, which they can in simple organizations. But as you start getting into more complex one, you can't do the same sort of scenario planning as you would with embedded logic, and I'll explain what that means when we get there. So from a balanced scorecard perspective, one of the things that we start seeing then is that business process framework and business process objectives are now integrated into a balanced scorecard. And there's one set of measures in a common tool. So, you don't have a separate balanced scorecard system and a separate business process management system. Activity-based costing, you see that continuous activity costs and process costs are always reconciled to the general ledger. And you now, from a project and portfolio management view, you start seeing that you have a portfolio view of projects and business processes. And there's always this ongoing value of improvement opportunities and value. So I always know, like I said before, what my non-value-add activities are, but I've associated them to some sort of potential project in which I could invest. So in terms of what this looks like, I start seeing this enterprise view of capacity. So I can translate my objectives or the volume of work into something that tells me how much work it's going to take. And anybody who does sales and operations planning, this should look fairly familiar to them. And so what they're doing is what the models do is translating demand into activity volumes and calculating work. Pretty basic math. Second thing that comes out of this is what I call matrix management. So if you can think about after you finish your budget process, what you can look at is if you can imagine a single report that lists all your expenses at the top and then the processes on the bottom, you'll have a report that reconciles all those things. Well, so what that means is that I now have one view of process costs that people view as being accurate. And if you look at a lot of operational excellence and process improvement, one of the things that inhibits those sorts of efforts is that people don't believe the numbers. And if they're not reconciled to the budget and the actuals, people don't believe them. So this really provides a basis for driving those sorts of things, and then also driving strategy across the enterprise. So it's these horizontal capabilities, so where you can execute processes across functions and entities, and that these models span different functions and entities. From that, I can then start looking at individual processes. So I can now look at, say, for example, an order to cash process, and start looking at cost per order. And one of the things that people talk about breaking down functional silos, and especially the impact of the budget, functionally based annual budgets, and driving this. One of the foundations for doing this is the ability to focus people on things like outcomes, like cost per order. So one of the things you want as part of an annual budgeting process, you might focus people on, say, $10 an order across 3 different entities as opposed to a functionally based budget. But what the process would do is give you a cost per outcome that is always reconciled back to the general ledger. So that's kind of the basic stage. This stage B, really talking about sort of more manufacturing specific things. Now, I'm not going to go into a lot of detail as to why organizations need this, but there's a separate video that we have on YouTube that describes why it is that you need manufacturing logic. I mean, ultimately, so for example, things like cash flow forecasting, foreign currency exposure forecasting. It explains why the math can actually be wrong if you don't have this. So this manufacturing logic, you would typically not support this kind of logic at a very detailed level. So if you had 10,000 products or 100,000 products, you try to support this with maybe a few hundred, maybe a couple hundred items at the product family level. So this is not a detailed model, but the logic required to support it is all the same. Likewise, you can support similar sorts of planning for non-manufacturing activities. So this activity-based planning, the only thing that wouldn't apply here is the inventory. So you could use that same logic to quantify activity resources. If you look at, from a platform perspective, in terms of the certain types of logic you need to support these things, you really need to have double entry cash flow logic, unlimited dimensions, models that can vary by time period, multiple model versions, being able to do mass model changes, automated variant. This is what I would see in a platform that supports this. And from a revenue and demand planning perspective, if you want to have a single revenue and demand plan that can be used by both finance and operations, you need to be able to have executed across functions and entities. You need to incorporate new products. You need to be able to have different versions, calculate average selling price. You need to have all these sorts of things in one application that will support a process for revenue demand planning. One byproduct that you get out of having this embedded modeling logic is the ability to do what I call distributed ownership of the model. So, for example, if one of the things is I have 20 buyers in a company, what I want individual buyers to do is just tell me what the parameters are for a how you're doing business with a vendor. So it could be, I need to know the cost of the products I'm buying. I need to know when the prices are going up. I need to know the discount calendar. I need to know how lead times are changing. So rather than a financial person going out and trying to figure out how changes to buying patterns are behaving, all I need to do is have a vendor update it, and the model will take care of the rest. And one of the things that this does is it collapses the planning process. So you now have the ability to get people to update all their models all at once and support what we call more concurrent planning processes. So, and this actually can be very useful as well when you're doing scenario planning, having more concurrent scenario planning process. So if you wanted to compare the cost of buying from one vendor to another vendor, you quickly get somebody like a vendor or an analyst or a buyer to update these sorts of things and articulate what's the difference in doing business with one vendor versus another. So that was stage 3. So stage 4 is what we call an outcome-based planning process. So what's different about this process compared to the other one is this process is executed horizontally across functions and entities. You can plan the execution of customer value propositions. You have more dynamic and rule-based driver models and even more concurrent processes. Strategy, from a performance measurement perspective, strategy and targets are directly connected to plans. You can plan, manage, and reward outcomes. And business process owners become part of the planning process. And the absence of those kind of horizontal processes, one of the problems that organizations find is that if you look at most kind of strategic corporate performance management tools, all these tools are all functionally driven processes. And when you plan functionally and your value propositions cut across multiple entities, you can't help but suboptimize how you're allocating resources. So that's really the problem that it addresses. In terms of some of the things that we talked about before, in terms of things like a balanced scorecard, the thing you'll find at this stage is that people talk about linking scorecards to budgets. At this stage, there's an explicit connection between a target and a resource. So it's a model-driven thing where assumptions are explicit in the form of trade-offs. Activity-based costing, you're having a continuous target costing process where cost structure is aligned with revenue streams. So that's embedded in the process. And there's no difference between activity-based costing and sales and operations planning in this process. From a project portfolio management process, you can forecast the value of ongoing and potential process improvements in projects, and all investment and opportunities go through one process. So one of the things that you want to do is have one place where changes to the business are all screened through a similar sort of process. And from a business process management perspective, this is the big thing where we mentioned that business process owners are now part of the process. So what I'm showing you on the screen here is what I call like a flow-based driver model. And what this model does is it connects the outputs on the left to the inputs on the right. And the big thing about these processes is that they really understand the individual flows that happen within a business. So if you look on the screen here, there's kind of three boxes on the left connected to 6 boxes, connected to 5, to 3, to 4 vendors on the right. So the number of flows that this would be modeling would be 3 times 6 times 5 times 3 times 4. So if you can imagine in a large business, this thing can actually flow millions, simulate millions of flows. And the thing about these models is that they're all cross-entity. They simulate the business, and this is a form of prescriptive analytics that people are talking about in terms of how it supports scenario planning. And kind of, it's not that these tools haven't been around for a while, but kind of what's new is that they've been embedded into systems that support both financial and operational processes. And in terms of how sophisticated the driver models are, I think that you can look at rules about how do you resolve capacity issues, step change cost functions, and flow specific bills and routing. So, for example, you may have a resources, bills and materials and routings that have one form if they go through one process or one flow, and they have another form if they go through a different flow. And when companies talk, when I talk to operational people about this, it seems like second nature. But when I talk to financial people, sometimes I think, gee, this sounds like it would be too complicated for me. But in the end, what you're really doing is getting ops people to articulate how they plan and manage the business and put it into one model. So in the end, what ends up happening is that you get a far better scenario planning process, but it actually simplifies it for the financial folks because they're not having to maintain the model, the ops people are. So what you have is a planning model that supports both finance and ops. And one thing I think that's really important to understand about why you would need these sorts of drivers is this whole notion of dynamic models. So if you see in the screen here, now I've put these circles here at the top, one on the left, which is 30%, 40%, and 30, and then over top the production process, 20, 60, and 20. So one of the things about a business is the importance of understanding mix. So the mix at the left is really driving the mix on the right. So, but if I change the mix on the one end, it automatically updates it on the end. So if you're a manufacturer and you're a $200 million manufacturer, this is probably far too much for you. But if you're a $2 to $3 billion manufacturer, these sorts of changes in mix can have huge impacts on your cost structure and cause these unforeseen consequences that we talked about earlier. So, this notion of having dynamic drivers can be really important as you get more complex because, when you start doing your scenario planning, the problem is that the results are just wrong. So we just talked about modeling. Let's just talk about from a performance management perspective what's happening here. So I had this graph in the last in stage 3 What's different here is I'm introducing this notion of trade-off management. So what we're bringing together here is the process costs together with what I call like these other things like perfect order fulfillment and days and receivables. These are what I call trade-offs associated with business outcomes, and this is something that would represent the metrics for like an order to cash process. So I'm now focusing people on these trade-offs and the integration between them. And in this case, I can show how the introduction of a new project or like an existing project or a forecast project would change those metrics. So as you can see now, I'm starting to integrate things like project and portfolio management into this, or at least the ability to understand how the projects or initiatives would impact the behavior of an order to cash process. And then what I can do is I can take this and I can drive it all the way through my business process framework. So what I now have is the ability to clearly articulate the key assumptions upon which I'm estimating my resource requirements and my cost per outcome all the way down the framework. And in doing this, what I can now do, because I have this model, I can now connect target strategy all the way down to my budget. So, you know, if I have revenue demand targets at the top and service levels and quality targets at the top, I can translate that down to an activity volume using mix assumptions and unit of measure conversions. I can then derive an operational plan with productivity rates and available resources. And then I can then derive a budget with people costs and purchase costs. So the thing here is at this stage, I've now been able to take a balanced scorecard and mathematically directly connect it down deep into the bowels of the organization. And I think that this is one thing that a lot of organizations are struggling with. Like, how do I take a strategy and then figure out, can I actually execute this thing? And this is, when you get complex, this gets really difficult. A lot of organizations are struggling with this. So that was stage 4. Stage 5 is what I call a dynamic strategy. And this is really describing organizations that can really drive change. So in stage 4, we're really good at operations, being able to really translate demand into resources and manage horizontally across the organization. Now we're at the state where we're really able to manage the introduction of change into a business. So our project and portfolio management system is included into a rolling forecast process. We're now able to do dynamic valuation of our investment portfolio, and we optimization integrates projects and ongoing operations. From a performance management perspective, we have all we had before, but one of the things as well is you can integrate things like knowledge management into the process as part of the feedback, and have an interconnected view of the enterprise. So if you look at the balanced scorecard process, you know, you're forecasting target attainment as part of the rolling forecast, where you can adjust targets and rewards. So if you integrate the human performance management system, these things are all connected. Productivity management replaces fixed budget, you know, from an activity-based costing perspective. Project and portfolio management, you have a formal change management process. So for example, one of the things that you want to be able to do is understand, what's my capacity to absorb change within the organization? You can incorporate those sorts of assessments into your forecasting process, along with the other metrics that you might be forecasting. And one of the biggest changes from a business process perspective is moving towards functionally based governance structures, because you have, or process-based governance structures, because you have the wherewithal to support it. So just going back to this planning model that we talked about before, you know, the boxes in the middle might represent, that are highlighted in red, really describe things where you may be making some investments in new processes, and because you understand the model as it is now and how it could be, you can simulate the impact on cash and therefore value the project. So your project valuation, investment valuation, is part of your ongoing model. From from a portfolio management system perspective, because you can forecast value, as you see on the right-hand screen. I've put a circle around the blue boxes there, or blue bars there, which really represent what's the value of a forecasted project. I can articulate that value deep into the organization. But what I can also do is take that and drive the value of an order to cash process and have this kind of dynamic portfolio management. I can integrate that with things like new product development. And again, go back to, do we have the capacity to manage, the introduction of this kind of change? So that was a quick overview of kind of the maturity model. So what I'd like to do is just quickly discuss a few topics and kind of review a few issues, which are to kind of bring it all back. So we initially started off with all these different kinds of terminologies. Hopefully you've seen how some of these things really are converging into one single maturity model. A couple of points though, one of the things is that if you look at how things like integrated business planning and integrated financial planning are being described today, what's being described are these, what I call more immature type of processes on the bottom left. To me, more integrated processes, or the strategic integration, is more related to the things on the top right, and it's really about managing complexity. And one of the things that we talked about that one of the research studies was the cost of complexity. And while this will change from one business to another, it really provides, a starting point to evaluate what's the value of these integrated processes. And increasing profits by up to 5% of sales is a starting point. So for every company, the cost of complexity will be different, but at least it's someplace to start with. From a rolling forecast perspective, I think that a lot of companies talk about doing rolling forecasts. And in small companies, you can support a rolling forecast. But if the larger you get, the harder it gets to do a rolling forecast. Maintaining the models can actually be terribly difficult. And if the process isn't resulting in an accurate forecast of cash flow, you got to wonder what's the value of these sorts of processes, especially if they're taking you that much effort to do. And as we talked about these processes, one of the things that we talked about were different types of drivers. And one of the things that companies are talking about is like zero-based planning or zero-based budgeting. And zero-based budgeting to me is just a means of how do I connect what I want to achieve with the resources I require. And I think that this integrated planning is really a sort of a more sophisticated form of zero-based budgeting or planning. And as you move up in maturity, these driver-based planning models give you a different level of accuracy. The level of effort to maintain them goes down, and the level of scenario planning accuracy goes up as you move down the maturity level. And just to kind of summarize these sorts of points, just imagine from a scenario planning being able to understand changes in volume and mix across multiple legal entities in a very large company. So having those sort of flow-based models that we talked about before may be appropriate to be able to do something like that. But then now think about, okay, well, how do I think about that along with, let's say I have a strategic sourcing effort and I'm looking at replacing one fairly significant vendor with another, moving from, say, United States to China. So how do I evaluate the impact of that? And then think about, okay, well, what happens if I have a big business event? So, for example, loss of a major customer, where I'm losing 20 or 30% of my business. How do I quantify that? So having a more sophisticated model that can simulate a customer value proposition can help you evaluate that much faster. But now consider the fact that all this happens inside a single time period, and you want to evaluate all these things simultaneously. That's where things get really difficult. So if you think about financial planning and analysis functions along with supply chain functions. They're doing all these things independently, and it's very time consuming, and companies don't have the wherewithal to manage complexity. That's the ability to do all this all at once. So in summary, hopefully this video kind of gave you an overview of some of these questions. What's common to these, to these integrated, these different terminologies we described. Why is integration important? What does fully integrated mean? And the difference between things like integrated business planning, integrated financial planning. I think hopefully we gave you some insight into this. So in terms of some of the potential actions people can take as a result of watching this video, we just provided a kind of a high-level overview of what the difference were. Develop a deeper understanding of what these things mean. Educate your management team about them, and get a shared view of what maturity looks like. Define gaps against maturity. Understand the value of these different maturity levels and how they apply to you, and develop a gap closing strategy. So with that, I'd like to thank you for watching this video. If you would like to ask any questions or need some more information, feel free to use the contact information provided on the screen.